So let's continue by talking about the demand in the foreign exchange market. So consider the demand for US dollars. These are going to be people and entities who hold some other currency but want to buy dollars. So they're going to be foreign consumers, foreign investors, local firms with foreign earned profits, foreign tourists, central banks, and speculators. So the demand curve for the dollar is going to be downward sloping, as most demand curves are, because if the value of the dollar falls, it means the relative price of US goods and services are cheaper to foreigners, and foreigners are going to wish to buy then more US goods and services, and therefore the quantity demanded for dollars will rise. So here we can see that in terms of a diagram. You can see that as the value of the US dollar falls in the foreign exchange market, the quantity purchased of dollars increases. What about the supply of US dollars? It includes people who want to sell their dollars to obtain another currency. So these are the people who want to get rid of dollars, not buy dollars. They want to get rid of dollars. And it includes domestic consumers interested in purchasing foreign goods and services, domestic investors who want to make foreign investments, foreign firms selling locally, and domestic tourists headed abroad, and central banks. So the supply here will be upward sloping, because if the value of the dollar rises, it means the relative price of foreign goods and services is less expensive. And Americans will wish to purchase more foreign goods and services, and therefore the quantity supplied of dollars will rise. So as the dollar goes up in value, it means that people will want to supply more US dollars, basically, for other currencies. Here we have the supply curve. You can see the 2 points there, C and D, with the movement along the supply curve, meaning that as the value of the US dollar rises in the forex market, that more people will want to buy the dollar. Want to sell dollars. So obviously you combine those two, you get an equilibrium. The demand equals the supply. And that should determine the equilibrium exchange rate. So what might cause us to move to a new equilibrium? In other words, for the exchange rate to actually move. So it's just the same as with any market equilibrium. Market price is above the equilibrium price, there's going to be a surplus and a move to lower the price of the good or service, in this case the US dollar. Conversely, if the market price is below the equilibrium price, there's going to be a shortage, and that puts upward pressure on the price of the US dollar. So what are the factors that are going to shift these curves around? So one, consumer preferences for imports. So in other words, the more imports that Americans want, the bigger is going to be the supply of dollars into the foreign exchange market, basically to convert those into currency in order to buy those imports from abroad. Secondly, productivity differences. An increase in the productivity in a foreign country will mean lower prices for their products and services in relation to US prices, and America will supply more dollars to buy these products. This will shift the supply of dollars to the right and decrease the exchange rate in the process. Real risk-adjusted interest rates. If the US real interest rates rise, then foreigners will wish to place their funds in the US, where rates of return are higher, and there'll be an increase in the exchange rate value of the dollar. Fourth, expected rates of inflation. So if there's higher expected rates of inflation, it'll decrease the demand and increase the supply of the nation's currency, pushing its value down. Actual price differences, according to the Purchasing Power Parity Law, or PPP, exchange rates will adjust to equate the buying power of the various currencies. For example, if a certain basket of identical products costs $20,000 in the US and $10,000 in the UK, the exchange rate should be $2 equals £1. If it's any different, clearly there's going to be some what we call arbitrage, and we're going to come on to that later in the chapter. 6, foreign exchange flows. The more attractive a country is for investment, the greater the demand for its currency, and therefore the higher the value of its currency. So here we have an example of an increase in supply of foreign currency. The supply of foreign currency occurs, and clearly that's going to be a downward move in the exchange rate. So it would be quite a big area there opening up for trading. As an example of inflationary expectations in the foreign exchange market. So if suddenly you expect more inflation, then that's going to shift that supply curve for the US dollar to the right. So more Americans will want to get out of the currency, if you like, so it shifts to the right. At the same time, the demand shifts to the left. So in other words, much less people want the currency. And what you see there is kind of self-fulfilling. It means that the value of the currency should immediately drop. So this is the thing about foreign exchange markets, is they are incredibly reactive to whatever's going on in the world and in the market. And so foreign exchange rates tend to move around a lot because of that. Before we close up this chapter, just a couple of kind of historical points. So gold standard. This was a system designed to give local merchants and households confidence in the value of the government-issued currency. So by maintaining a fixed price of their currencies in terms of gold, these countries ensured fixed exchange rates. So basically, if you can fix gold price to the dollar, and this was done actually in the 60s and 70s, then that's useful, because then you can convert anything else into dollars as well. World War I, by the way, brought an end to the gold standard, and there was an attempt to return to the gold standard in the interwar period, but it failed. And there's also been talk of a new gold standard even now, but the prospects of that really do not look very positive. 1944, the end of the Second World War, the leaders of 44 countries met in Bretton Woods, New Hampshire. Bretton Woods is a ski resort in New Hampshire, very nice one too. The meeting was officially titled the United Nations Monetary and Financial Crisis. It's always now referred to as Bretton Woods. And what it did was temporarily fix the exchange rate system to gold. And it did it through the US dollar. So everything was done through the US dollar to get to the amount of gold. The idea was that if you could keep US dollar stable, then other countries can fix their currencies, fix their exchange rates to the US dollar, and that should solve all the problems. Of course, it didn't. And by 1973, the system had collapsed. Why? Because basically the US was printing so much money because of the Vietnam War that it needed to depreciate its currency. There were too many dollars around, and so the dollar should be worth less, but it couldn't be worth less because it was within the Bretton Woods conference agreement there, which basically fixed everything else in terms of the dollar. So they realized that, it just wasn't going to work, unfortunately. And here's some kind of group thinking, group discussion questions. Please explain how exchange rates are determined in foreign exchange markets. Well, I think you've done that during this chapter. Discuss how, as incomes rise in the US, this may cause the demand for the dollar price of yen to rise. So it's saying as incomes go up, what's going to be the impact of that on the foreign exchange market? Under the gold standard system, what did each nation have to do? Basically, they had to have enough gold on hand to be able to convert whatever money they issued into gold, because everything had to be ultimately backed by gold. So in a gold standard type system. That can be problematic, of course, because first of all, gold is being mined all the time, but secondly, it could be problematic just because there could also be problems with individual firms, and it's difficult to know what to do in that case, given that they they have to kind of maintain the price of gold, so that basically means that the supply and demand have to be in balance. So this is what we've done in the chapter. We've done basically a bit talking about the foreign exchange market. By the way, it's the biggest market in the world. Something like nearly $4 trillion is traded every day through the foreign exchange market. One thing I didn't talk about is where it's done. It's done really around the world, 24/7. And the largest foreign exchange market is actually centered in London. Then New York City is a kind of a distant second, and then there's the other smaller hubs for trading and speculating in foreign exchange. The trading occurs 24/7, and we've covered in the course the demand for forex, supply of forex, the equilibrium and the factors which shift that equilibrium, and then these different exchange rate regimes. Fixed and flexible are really the two that you should know about. Thank you very much for listening.